The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The NASDAQ 100 stretching to an 8th straight day of gains, a 3rd straight day of record highs. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. on this Friday. Happy Friday. We're almost there. Let's take a look at the S&P 500. The S&P 500 has rallied every single day this week. It looks like we're going to close there, but a lot can happen in 1 hour. The NASDAQ 100, as Romaine mentioned, powering ahead right now, up about 0.6%. A different story when you take a look at the bottom of my screen. The Russell 2000, the small caps, down once again today to the tune of about 0.7%. It might have to do with what we're seeing in the bond market after that big rally that we've been looking at all week. You can see the 10-year yield rising a little bit right now, up about 4 basis points, back above 4%, Romaine.
And when you put it all together here, particularly when it comes to equities and the move higher in the NASDAQ 100, it is an impressive rally, but it still is a relatively narrow week. Fewer than half of the names in the green. 80% of the weekly point move attributable to just 3 names: NVIDIA, Broadcom, Tesla. Still, investor sentiment was strong enough to not only propel those names higher, but also support one of the busier weeks for IPOs this year. 8 notable entrants, and that includes Figure, Via Transportation, Gemini, and Blackstone-backed Legence. A conversation with the Legence CEO just a few minutes ahead.
Wall Street has been too bearish. Their price targets currently are at 6,200. The market's at 6,550 or higher. So Wall Street's going to have to raise their price targets because they're too low. Earnings estimates are too low. First and second quarter beat, and yet numbers for Wall Street have come down.
It's kind of clear what equity strategists need to do, but what about the bond strategists? The macro story was dominant this week. It gets even more so next with the Fed rate decision. Interesting repositioning out there that could actually signal a sell the news type of event. With rate cuts largely priced in, PIMCO's Dan Ivison actually pulling back from one of the hottest trades that had successfully bet that the gap between short and long-term yields would widen. Take the differential between 2- and 30-year yields, which had actually widened in 24 of the first 34 weeks of 2025. But that steepening, it stalled in the month of September. Long-term yields lower for a second straight week, Katie, to the lowest since April, and short-term yields now rising for the first time in 5.
Let's put it all together and take a look at this chart. This is the 5s, 30s that I have behind me. And as Romaine mentioned, at least PIMCO taking some profits here. This had been the bet. It had sort of been the conviction trade when you look across the bond market that you would have short end rates drop here and maybe the long end stay under control, maybe rise a little bit. You add it together, this steepening is what was produced. Now, this had been the trade in 2024. It broke a lot of hearts, but it's been working so far in 2025. You can see it's really accelerated since about April or so. Whether or not there's still steam in this trade, whether there's more juice to squeeze, at least PIMCO says maybe now is the time to take profits.
Let's kick you off to the close this Friday afternoon with Cathy Jones, Chief Fixed Income Strategist at Schwab Center for Financial Research. And Cathy, just to kind of be clear here, I mean, Ivison isn't necessarily saying the steepening trade is over, but he is kind of highlighting the idea of a lot more uncertainty that complicates that trade. Do you actually see a little bit more potential for that steepening to continue?
Yeah, we thought this would be the dominant trend in 2025, and that's turned out to be the case. The fundamentals still would suggest some steepening because you've got to get short-term rates down. We do have them down to a level now where the market's really discounting a lot of Fed easing. I don't know that the short end can go down that much, but I think long-term rates, we still have inflation pushing 3% plus. We still have rising fiscal deficits, not just in the U.S., but around the world. And that's just kind of keeping the long end elevated. So I think there's still some juice left in that trade, as they say.
What, if anything, changes based on kind of what we think is on the horizon? I mean, everyone at least assumes we're going to get multiple rate cuts over the next few months.
I think it's a really tough question for the Fed. I mean, we've said this all along. They're caught between the inflation coming from tariffs and limits on immigration, keeping the job market kind of tight in a weird way, right? No hiring, no firing. But you also have the slowdown that comes from tariffs and the immigration limits.
Yeah.
And so this dual effect has kind of kept us, I think, the Fed waiting to see which one comes first, which one wins. And I think we're going to have a choppier market than what is priced in. I don't think it's going to be cut, unless we tip into recession. I think they're going to cut, wait a little bit, assess, cut again if the economy is evolving as expected.
So maybe a stop and start rate cutting cycle is what we're heading towards. I want to talk a little bit more about how this plays out at the long end. You mentioned that there's a lot of rate cuts priced into the short end, but you think about some of the currents that you mentioned when it comes to tariffs. You also think about deficit concerns and the like. And then you think of the long end's traditional role as sort of this haven asset that typically when you see some of these events come through, that you see long end bonds rally, they've been unreliable here. So how are they set to behave heading into these next few months?
Well, my best guess is if we were to really hit a downturn in the economy or some sort of global event that was very negative, bonds would rally. The long end would rally because it still is a safe haven, and that hasn't changed. But I think short of that, when you get a lot of volatility in policy, a lot of volatility, we're going into the debt ceiling business again in the next couple of weeks. We have a lot of policy uncertainty here and abroad. We're seeing a lot of that abroad. And so for that reason, I would be surprised if it's just a smooth sailing market. I think we're just going to see a lot of volatility. So yeah, still a safe haven, but not really a ballast in the sense that it used to be. It's subject to a lot of volatility.
And let's bring this conversation to the corporate credit market as well, because you take a look at spreads, whether it comes to IG, whether it comes to high yield, it just feels like we're very, very tight. And with that in mind, where's the value to find when you're looking specifically at credit?
Yeah, I mean, we've been up in credit quality, intermediate term all year, for more than a year, and still like that trade. Corporate profits are still going pretty well, but the spread is so narrow, it's so tight, that there's no room for error. So if something goes wrong in the economy, we're already starting to see a lot of dispersion in the high yield market between the better credits and the lower credits. So I certainly wouldn't overdo corporate credit here. They've had the benefit of lack of issuance in longer term treasuries to compete. They've had good corporate profits, good fundamentals, but it's all priced in.
I am curious as to how you factor in general, political risk. Obviously, there's a lot going on in this country. We have, as you just mentioned, for some reason, we're talking about stopgap budget bills again. And of course, we have a big midterm election in the country next year. How does that get factored in to your forecast about where yields can go? Or is it not that big of a factor?
It's not a huge factor, but it's something to consider. So it kind of widens the band. You know, we do sort of a fair value estimation for Treasury yields. And then we have a band around it. And that band has gotten a little bit wider over the last couple of years because we've had a lot more things we need to take into consideration. One is just the term premium. So the more uncertainty there is, the higher the term premium estimate, and that gives us a wider band around our fair value.
All right, Cathy. Always a great conversation. Cathy Jones, Chief Fixed Income Strategist at the Schwab Center for Financial Research, kicking us off to the close on this Friday afternoon with our eyes on a big IPO in the crypto space. Again, we're going to talk about what the continued institutionalization, Katie Greifeld, of crypto means for the future of the industry. The Tether co-founder, William Quigley, joining us in a second.
I'm glad you said that word and not me. That was a mouthful. We'll also talk about Gemini, or rather, it's not the only company going public today. We're going to sit down with the CEO of Legence to talk about the company's big debut and what's next for this newly public player.
And we had a chance to catch up with the CEO of Chipotle, Scott Boatwright, nearing his one-year anniversary at the helm. We want to hear what he had to say about how that company actually competes on price. All that and more coming up in just a bit. This is The Close on Bloomberg.
Gemini's space station shares higher on its first day of trading. The Winklevoss-backed cryptocurrency firm, just one of several IPOs in the digital asset space this year, really underscoring the market's appetite for these companies. Our next guest helped launch what is now the most widely traded stablecoin to date. His name is William Quigley. He is the co-founder of Tether, joining us now. William, great to have you with us. Let's talk broadly here to start. The fact that you are seeing a lot of these cryptocurrency companies come to the public equity markets and begin trading. And so far, William, it seems like the demand is there, at least when it comes to the first day pops.
Yeah, and I think it should be, because these exchanges, next to maybe stablecoins, exchanges are probably the next best, most profitable companies in the crypto space. Billions of dollars a year in free cash flow. So exchanges have turned out to be very good investments. Now we'll see what happens as the Clarity Act eventually passes and big Wall Street firms enter the market. That'll bring a lot more competition. But thus far, they've been very profitable and attractive investments to have.
And William, it's interesting to hear you specify exchanges here. Crypto exchanges have been well received, because when you think about the other crypto-related equities that are out there, there's a lot of digital asset treasury companies. That has become a very popular phenomenon, if you want to call it that. But it seems like the juice that you're getting from announcing that you're adding digital assets to your treasury has been lessening over the past few months.
Yeah, it has, and I'm not a fan of these companies. I understand why people think they're a good place to put their money, because it looks like you can actually make more money in some of these stocks than buying the underlying crypto that the companies hold. But I think that premium to the net asset value of their crypto treasury, that will diminish over time. Generally, these things work that way. If you look at any traded assets, when they're encapsulated in some captive entity, they generally trade at or slightly below their net asset value. And I would also say you're not getting that much additional upside when you do buy these things. If you really like Bitcoin or Ethereum or some other crypto, my recommendation would be you directly hold it. And the promise in some of the DATs is, well, they'll allow you to earn a yield because they're going to do something with your crypto. But I would say that yield is being earned by them putting those tokens at risk in some way. That's how they're generating the yield. You're already taking a lot of risk holding these very volatile tokens. So my recommendation would be stick with the direct ownership of the token. Buy ETFs, they're great. But probably avoid these companies. A lot of people have alluded to them being a lot like SPACs in the way they get hyped up and then down, and I share that view.
When we talk about risk, and obviously a lot of the new entrants into this market have been in the, I guess, the treasury space when it comes to crypto assets. We've also seen a few entrants with regards to stable coins, which I would think on the surface would offer a level of exposure, at least to the whole digital asset ecosystem, with significantly less risk. When you look at some of the entrants that have come to play here, what are you seeing?
So I would say, and look at Circle, right? I mean, it's got a $30 billion market cap. Went public this year. Tether has $170 billion of assets that back its stablecoin. And my views of stablecoins have been the same for a long time. I think the stablecoins are the greatest innovation that's come out of blockchain, even more so than Bitcoin itself. And with things like the regulations that are now moving through Congress, I think you're going to find lots of companies, hundreds of companies will issue their own stablecoin, because it's such a good way to avoid a lot of the costs that traditional payment systems have layered onto these companies. And I think a lot of people are very happy to hold these stablecoins. So I expect this is going to be where the most value will accrue in the crypto space. It'll be around stablecoin focused businesses.
What about the backing of it? And we should just point out, Tether, at least with USDT, I think they're now at 170 billion. I had a chance to catch up with the folks over at Cantor Fitzgerald the other day, which of course helps them manage the reserves. Also, there's a story on the Bloomberg terminal today, William, about now Tether actually looking for a US-based stablecoin, something that would actually meet this new regulatory environment we're in. Where are the dollars or other assets coming from to back up what that coin represents?
The best place to put it would be U.S. debt. Now, U.S. debt, of course, has no risk of default, but it can go up and down depending on the movement of interest rates. So I think the best way to collateralize stablecoins would be with short-term U.S. debt. No risk of default and lower risk of interest rate movements causing a decline in the underlying value. And I think that can, with a good risk management department, that can be very well managed. I think most of the banks that will issue stablecoins, and it's not just going to be banks. I think the smart consumer-oriented companies, if you have 100 million customers or multi-100 million, if you're a Facebook, you should absolutely have a stablecoin. And I think what we're going to see is a convergence of best practices around what assets are best. Like I said, U.S. issued debt, probably best, but I could see gold, perhaps some other very, very high quality municipals or corporate debt. There's certainly going to be more reserve than, let's say, your bank deposits, which are lent out 10 to 1 because of fractional reserve banking. So I'm less worried about that. Yeah. And I think, like I said, they'll become a best practices that most of these companies will just follow.
All right. Well, we have to leave it there. Always great conversation. William Quigley there, of course, many of you know him as the co-founder of Tether, now runs a blockchain equity investment fund that's invested in a lot of the more notable entrants to the public markets in that space, including Coinbase and Circle. When we come back, we're going to talk about the state of retail, luxury furniture retail, and some interesting comments by the CEO of RH on how U.S. tariffs are hurting his company and the furniture industry. This is The Close on Bloomberg. Let's get right to our top calls. The big movers on the back of analyst recommendations, and we start off today with General Motors. Barclay upgrading to overweight from equal weight and raising the price target to $73 from $55. The upgrade in the analyst view on the U.S. autos mobility sector. Well, that's coming now that tariffs are, quote, well understood by the market and with potential for further easing. The shares, though, relatively unchanged on the day. Next up, let's take a look at Alaska Air. UBS upgrading to buy, the price target going all the way up to $90 a share. The upgrade for Alaska Air now means that it has 15 buys, no holds, no sells, believe it or not. The analyst that we heard about today believes Alaska Air's earnings are about to take off. Those shares unchanged on the day. Finally, SL Green, Citi upgrading the real estate investment trust to buy, citing the strength of the New York office market. The shares up 4% to the highest level since February. We're also keeping an eye right now on what's been going on in the furniture space, specifically upscale furniture with RH. The shares pulling back a tad here on the day after cutting its revenue forecast for the full year due to the impact of U.S. tariffs. Our next guest raised his price target on the stock just last week to $233 from $200. Stephen Zaccone joins us right now, retailing, broad lines, and hard lines analyst at Citi. And Stephen, of course, we have to start with the comments by the leadership, by the management over at RH, making no bones about it. The tariffs are hurting its business, and more importantly, it doesn't appear to have a line into the White House. What's going on?
Yes, I think that was the most entertaining part of the call, is basically the CEO kind of pleading for the White House to call him and talk about furniture tariffs. It's a challenging environment to kind of navigate, right? And I think the takeaway from last night's call is they're making changes in their business. They're delaying some of the source book mailings, which is their kind of catalogs to introduce new product because of the tariff uncertainty. You know, the admission is like, it's really hard to price our product. We don't know what the tariff rate is going to be, right? And that's before you even think about some of the sectorial tariffs that are coming in, the 50-day window that Trump has talked about with putting new tariffs on furniture. Yeah. So there's a lot of uncertainty in how to plan the business because of the tariffs.
I'm not unsympathetic to that, but we're also talking about a business, at least if you believe its own numbers, is already saying that, at least with this upholstered furniture, at least 50% of that is right now being sourced domestically here in the U.S., primarily from North Carolina. And I know it's made some other moves internationally to try to find sources that will be, I guess, less exposed to tariffs.
Yeah, I mean, they're doing the best they can. You know, furniture still is a it's a product that's really largely produced outside the United States. We've done a lot of work just talking to some of the domestic manufacturers, and you're still importing a lot of your raw materials from there, right? Like the steel and aluminum tariffs have really been challenging for this sector. So it's not as easy as let's just bring them production back to North Carolina, Michigan. Listen, we'd love to see that happen for the country, right? But it would take a very long time for that to play out. So I think the commentary last night from CEO Gary Friedman was basically, let's have a discussion around how that can happen over the future. And we cover Williams-Sonoma, and CEO Laura Alber has kind of talked about the same thing. Is let's kind of have a seat at the table and talk about how this can happen over the next 5 years, because it can't really happen overnight.
It was also interesting to read more of the commentary, especially ahead of next week's Fed meeting. Friedman also saying, I'm more motivated about killing inflation than getting an interest rate cut right now, because we had an interest rate cut and the tariffs create more inflation than anybody thinks. Again, we'll hear from the Fed next Wednesday. But Stephen, talk to us about the underlying consumer. Tariffs aside, is the underlying demand there?
It was the interesting takeaway from RH last night for us is the fact that you saw them kind of lower their sales outlook. Now, they said it was specific to their business because of some source book mailings, but Williams-Sonoma reported a couple weeks ago, and they raised their sales outlook, right? They had encouraging commentary that things had improved in their business from a demand perspective over the summer. And the commentary around back to school and kind of furnishings demand more recently, some of the high frequency data has looked pretty good. So I think it has been a little bit surprising, the deviation a bit from RH. Now, RH did inflect positive sooner than others, right? So they're starting to lap some tougher compares. But I think when you zoom out on the consumer, we've talked about this more recently, but the themes from the second quarter earnings is the consumer's been pretty good. It's been choppy out there, but I think they've held in, and back to school is kind of the catalyst right now. As we get into holiday, you'll shift to see what the consumer spending environment is then. But, most management teams in retail seem cautiously optimistic, right? Tariffs are an unknown, what happens with pricing, but cautious optimism is a good way to, kind of talk about the consumer right now as you think about the back half.
All right, Stephen, great to get some insight from you. That is Stephen Zaccone. He is retailing broadlines and hardlines analyst over at Citi. You take a look at RH shares right now, Romaine, down 4%, which is not good, but they were down much more mightily in the after-hours trade.
Yeah, it looked like it was going to be worse. And we should point out for all of the CEOs, the proselytizations, and I understand why he's upset. When you really dive into the numbers and what they're doing here, they do have something that insulates them to a certain extent here. It's just a matter of how much he's going to lean into that and whether he can, I guess, get someone on the phone.
Absolutely. Well, coming up...
Call us.
We'll
take you.
Why not? We're not the White House, but we're not so bad. Anyway, coming up, we had a great conversation with the CEO of Chipotle. We'll bring that to you next.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, and we're really focused on lunch right now because we both had
I had
it.
a great lunch. Yeah.
I did too. I think we had lunch from the same place, actually.
We did. It was a new place.
I got the cauliflower rice.
Yeah, it was very healthy. Bone broths. And, I had to, but it was good. Now the great thing about this is we didn't actually pay for this. Someone else paid for it, so I didn't see the prices.
Don't say that out loud. They might stop paying for it.
But this is the whole thing right now. Everyone is so price conscious, right?
That's true.
Some of these fast casual places, you're paying $15, somewhere up to in some cases upwards of $20 for just a basic bowl or salad.
That's the thing. You're probably going to get sort of the same thing. There was a really interesting BTIG survey about basically the value that you're going to get at the different chains. And they found that Chipotle actually has a significant value advantage over its peers, but they're not broadcasting it the way that maybe they should be.
Go on.
And, we actually had a chance to speak to the CEO of Chipotle about that exactly topic. His name is Scott Boatwright, and he said about that BTIG survey that their plans to grow the brand internationally is also a focus, as well as how their pricing compares to their peers.
We have been historically about a 10 to 15% discount to QSR and almost a 20 to 30% discount to our fast casual peers on what I believe to be a better offering. And we always talk about value here at Chipotle as benefit over price. And what we endeavor to do is hold price constant for the consumer and then really lean into the value of the offering. And so when I think what's most important about that, and to answer your question more succinctly, is we've got to lean into or better communicate the value that is Chipotle. And so if you think about it at its core and the core equities of the brand, it's this idea of sourcing the best ingredients in the world, the best animal welfare practices in the industry, delivering that experience fresh every single day with classic culinary techniques, and I'm talking pots, pans, knives, and cutting boards, at a speed and variety and abundance in which you can't get anywhere else. I think there's still extraordinary value in the Chipotle proposition, and again, I think that's something we need to communicate more effectively.
Well, let's talk numbers here, because BTIG writes that your core entrees average around $10.13. Your chicken entrees, which are about 60% of your orders, those average around $9.60. So call it $10. Can you feasibly go much below $10 in this current landscape?
You know, I think it's priced. The price point in which we serve it today is on par with consumer expectations. And so we built this great brand on the core equities I spoke of just a moment ago over our 32-year history. We have been very judicious, if you will, as it relates to pricing over the past many years. I know food inflation out of home is significantly outpacing food inflation at home, and our pricing strategy is tracked more closely with food inflation at home, which continues to drive this gap in the value that is Chipotle compared to our peer group.
Well, I am curious then, what are we talking about here, Scott? Are we talking about a meaningful effort to compete on price? Because there are some pitfalls there we've seen in the past, certainly in the quick service space and also in the fast casual space. When I think of Chipotle, I don't necessarily think of it from a price perspective. You think of it, and this is largely due to the marketing you guys have done over the years, as more of a, I guess, quality sort of play. And I am curious as to where the balance is between price and quality.
You're absolutely right, Romaine. There are many brands today that are competing on value as a price point. That is not who we are as an organization. We feel like we charge a fair price for our offering today. And so you won't see us competing with the big players that are working value meals on a price point. That's just not who we are at our core. We believe what's happening in the market today is more macro headwinds that are related to the low-income consumer, middle-income consumer, that are being very conservative on spend because of other macro concerns that they may have about potential looming recession or tariff impact on their individual pocketbooks. So we think we're priced competitively, and we will continue to lean into the offering. We'll continue to lean into innovation in a meaningful way to give our core consumers a reason to come back more often or drive new consumers to the brand.
You've been at the helm for coming up on a year now at Chipotle, and I am curious about expansion strategies going forward. You have made some strides in the Middle East, made some strides in Europe, and there, of course, is a big announcement here that now Chipotle will indeed have its first stores in Asia, a partnership with South Korea.
That's right, Romaine. So we started our partnership with Alshaya about a year and a half ago. We are up to 5 restaurants across 3 markets today. We're in Kuwait, Abu Dhabi, and Dubai with a lot of success. Well, we're really happy with the partnership. Alshaya Group is happy with the partnership, and we plan to expand aggressively in that region over the next couple of years. We did sign up a partnership with the Alsea Group down in Latin America. We should have our first restaurant open there in Monterrey, Mexico in the upcoming year. This partnership with SBC in South Korea will be a really meaningful one for us. It's more of a joint venture, so different than our partnerships with Alshaya and Alsea. And we believe that the core products of Chipotle will resonate really well in South Korea and Singapore.
And when it comes to the international expansion, my understanding is that you have more than 3,800 restaurants worldwide, but 98% of them are in the United States. So when you think about your bottom line, how long will it take before international actually starts to move the needle for you?
Yeah, so we have stated publicly, Katie, that we plan to build up to 7,000 restaurants in North America. The international strategy, we are taking a very slow, measured approach just to prove out the concept around the world with big, large partners that we have a lot of confidence in their ability to operate at scale. They have access to capital. They have access to real estate. And so it'll look very different how we scale globally versus other brands, other U.S. brands that have gone into other countries. But more importantly, the layers of growth that international will add it will add layers of growth for our business as we enter a point of maturity here in North America, and will be critical to our long-term growth story.
And that was Scott Boatwright, the CEO over at Chipotle. And we should just point out, remember, he basically took over back in November of last year. Katie, the shares have been one of the bigger underperformers, down about 36% so far year to date. Remember, the last two earnings periods you saw a contraction in same-store sales. So a lot of what he's talking about there on price and quality, the expansion in the middle, in Asia, et cetera, that's going to be really important to sort of turning this around.
Well, bringing it back to BTIG, their point that if they sort of advertise on the fact that they do have lower prices than their peers, maybe that can help turn things around. But of course, shares certainly in the hurt locker year to date.
All right, well, some shares that are doing well today. The company's called Legence. The ticker is LGN, the newest entrance to the market, an IPO for the HVAC company, an HVAC company with a story to tell. The CEO, Jeffrey Sprau, joins us in just a second. This is The Close on Bloomberg. Time now for our stock of the hour, and we're taking a look at the newest entrance to the market, Legence, the Blackstone-backed engineering company, joining today's IPO parade. The shares higher on its first day of trading, and pleased to say that the CEO of Legence joins us right now, Jeffrey Sprau. A good day for you, good couple days, $28. It was the IPO. You raised more than $700 million. Where's that money going to go?
Yeah, it's going to go down to pay down debt, and we're really excited about today. It's a monumental day in the history of our company. It's exciting for our 6,000 employees to be able to participate, and they really brought us to where we are today, and the future looks really, really bright.
And I'm curious about why now specifically. This is something that we ask most new IPO CEOs, the fact that, for a long time, the window seemed to be closed. What about this moment gave you the conviction to finally come to the stage?
Yeah, it was a number of things. Certainly our performance as a company, sort of growing from a single solution provider to being a holistic, what we call a life cycle building provider, which is a combination of professional services up front, such as master planning and program management, and engineering and design and consulting, with the installation and maintenance and service on the back end. So as that's grown, and as we as a company have grown, we've had great success. Now that coupled with market growth in those complex buildings, which are really in our wheelhouse, those two factors combined, and I think the overall sort of interest in the tailwinds associated with the digitization of our world, or onshoring or reshoring, or energy efficiency as a way to reduce costs of a building. I think all those things went together to get us where we are today.
Well, that's what I found intriguing about the business. And talk about kind of what types of buildings are being built. You use the word complex, and I think that might understate it. I mean, I know now we typically tend to look at it through the lens of data centers and AI, but even just a regular old-fashioned office building is way more complex.
For sure. And we like to say we don't do 72 and sunny. The more complex, the better for us, because the industries we play in are technology, which would include semiconductors and memory and data centers, as well as healthcare, biotech, and pharma. Those are very intricate environments that impact the mission of those companies. And so you think clean rooms and labs and surgical suites. You have to know what you're doing.
And a stable environment.
Absolutely right. It has to be predictive. And if you're manufacturing pharmaceutical and you lose the environment, you lost that lot of product.
Well, let's talk a little bit more about stability in the context of what's going on the global trade scale, because the theme out of this most recent earnings season, and the one before it, of course, was tariffs. And I'm wondering, if you situate your company in that conversation, do tariffs have an impact on you or your customers? Yeah,
they certainly haven't so far. We take a very deliberate approach. Every proposal that we put together is based on hard prices. So we don't need to speculate on what a raw material might do, or what an equipment purchase might do, or what even labor costs might do. And so that insulates us from a tariff impact. Now, I can't predict the future and what that might look like in a couple of years, if it might have an impact on construction or renovation. But here to date, we have not seen an impact.
I am curious just about the general pullback that we've seen from a lot of ESG initiatives. The idea that certain corners of your industry had been aided by policies here in the U.S. as well as even in Europe to create more environmentally friendly buildings and ecosystems. Has the pullback, at least on the U.S. side, affected you at all?
No, and I think that the offset there is energy efficiency, whatever you want to call it, whether it's decarbonization or sustainability, is a reduction in your energy spend. and that's good for business. And that's a major part of folks' OpEx. And so to the extent you can improve that, it doesn't matter what the policies are or what you call it, it's good for business. And I think that as a result, we haven't seen any pullback from that perspective.
All right, Jeff, I know it's been a busy day for you. We appreciate you spending some of it with us. That is Jeffrey Sprau. He is the CEO of Legence. And really interesting, again, this conversation that the IPO window seems to be wide open for really a wide variety of companies here.
Yeah, we had at least 8 big ones this week, including a couple crypto companies that were able to come. And remember, we're expecting some more. StubHub was expected to potentially price this week. Looks like that gets pushed into next. So it's been a huge deluge. And I was looking at the league tables on the Bloomberg. Have you looked at them?
Not recently, but tell me about them.
We're actually tracking at pre-pandemic levels right now.
There you go.
Yeah, how about that, Katie Greifeld?
Certainly. It's like it never happened. Now, coming up, we'll take you to the closing bell with Binky Chadha. He is Chief Global Strategist and Head of Asset Allocation at Deutsche Bank. That conversation up next. This is The Close on Bloomberg.
10 minutes until we get to the closing bell. Romaine Bostic alongside Katie Greifeld with the S&P stretching to a 5th straight day of gains, or at least is trying to get there here, basically unchanged right now as we get closer to the bells. So far, seasonality hasn't been to the detriment of the S&P 500 this month, but we know it's early still. Yeah, and we should point out we've had, if today actually closes in the green, this will be the 4th straight day that we've had a record high on the S&P, which maybe underscores the idea here that despite all of the hand-wringing about the economy and tariffs and everything in between here, at least for right now, corporate fundamentals are holding up. Binky Chadha joins us right now, Chief Global Strategist and Head of Asset Allocation at Deutsche Bank. And Binky, you just raised your price target for the S&P 500. 7,000 to end the year.
Yes, that's correct. Yeah. But I should say that we started the year at 7,000, so this is just sort of coming full circle back. The reason for lowering things in the middle, though we remained basically pretty constructive then, and we argued there was still plenty of upside, was really the impact of the tariffs. And if you think about the impact of the tariffs, if I look at macro growth, we can talk about the consensus, but look at the Atlanta Fed, it's still holding at 3% for the 3rd quarter. If you look at earnings growth in the 2nd quarter, everybody was looking for it to slow. Growth actually picked up. I would say, very importantly, if you listen to companies on the impacts basically of the tariffs, they would argue it's been so far, obviously and very clearly a negative, but it is basically looks like it's manageable. I mean, some companies would say that before the tariffs, and I'm talking about tariff impacted companies here, right. We had basically a range for our guidance. So the tariffs put us in the lower half of the range. Without the tariffs would be in the upper half of the range. That's basically suggesting it's within the range of sort of normal variation.
But one thing I'm curious about, though, too, I understand that we're kind of looking backwards and saying, okay, we had this expectation that companies were really going to be hurt. So far, we've seen corporate fundamentals hold up, and you actually did raise your earnings up projections for the S&P. But then we have like this University of Michigan sentiment number today that's showing that consumers longer term are looking at their potential lot in life and saying that it's going to get worse. And I am curious as to how you balance that all out.
So what I would say is that's actually, a major blessing in disguise. And why that is because, so we were just talking about the tariffs. I mean, I think, the big risk and uncertainties have really been created by economic policies and, all the uncertainties, et cetera, et cetera. What I think it's important to keep in mind is that, in our view, basically a major check and balance in the system is really, presidential job approval ratings. And after an initial honeymoon period, they tend to land where consumer confidence is. So the fact that consumer confidence come down means that's the risk that is where presidential job approval ratings will land. So a strong incentive to keep the economy basically going is the way that I would put it.
Well, that ties nicely to the sentiment figures that we got this morning out of the University of Michigan. The preliminary read for September coming in well below expectations, well below the prior read. But I want to go back to the impact on corporate America from tariffs, because the RH call, again, that CEO very clearly saying this is a negative for my company. But you think about what's driving the S&P 500. You think about big tech. It just feels like the tariff impact, it's so uneven on the landscape.
Absolutely. I mean, I would make 2 points, So one is basically we do have concentration, but what I would emphasize is the earnings concentration rather than the market cap, which sort of, more is sort of reflecting that earnings concentration. Now, if you look at Q2, as I said, we saw earnings growth actually pick up. Earnings growth for the S&P is running about 10%. Typically, outside of recession, it's around 11%. So it's like, it looks very basically normal. In terms of mega cap growth in tech driving earnings, they've been doing that for the last 2 years. So that's not really something that happened in this quarter. Now, the tariff impacts have, of course, fallen disproportionately elsewhere. And in terms of thinking about the impacts of tariffs on earnings, we've got a variety of ways of teasing that out, basically, because companies don't disclose that. You can't do it in a comprehensive manner. But once you do that, then if you buy our screens that do that, and you take all-inclusive screen, what you get is that out of the S&P 500's earnings, the companies that are directly negatively impacted by the tariffs comprise 17%. So 1/7. That's a pretty small number. Yeah. And I would also say, one company, Apple, makes up 5 percentage points of that. So we are talking about 12%. Wow. Apple is the only major tech company that talked about the tariffs, but it was a very reasonable earnings report and had a small impact. So I think the bigger picture point is also that other things are going on, and they can easily, more than offset what the tariffs are doing.
I just want to quickly acknowledge the rest of the world stock market, because you think about your year-end S&P 500 target being raised to 7,000. Does that come at the expense of some of the outperformance that we've seen when it comes to the European equities and other markets as well?
I would say it doesn't come at the expense. I mean, I think we're all familiar with the big gyrations that we had in absolute and relative performance. So bottom line is we are overweight Europe. I'm overweight basically the US and Europe. I think in Europe, the question is, and the current question mark is Europe going to start to grow? Our house view is that it will, but it's relatively modest. My personal view is the risk is really to the upside, because what I would argue is, it's also true of various other aspects, even in the U.S. If you look at U.S. manufacturing, we've been going sideways if you look at the ISM for 3 years. And Europe is a very similar picture. But if things were bad, we should have been going down, not going sideways, just below 50 like U.S. manufacturing. So I would argue Europe, the level of activity has been going sideways since early 2022. And so the risk is that you're going to get a recovery. Just, there's just the potential for catchback is huge. So I want to remain long because I don't want to miss that. It will be a level impact, just like we saw earlier this year.
All right, Binky, always a pleasure, always informative. Binky Chadha, Chief Global Strategist over at Deutsche Bank. Some breaking news right now, this involving leadership over at Bank of America. Brian Moynihan, who's been in that seat since at least early 2010, we're now getting the contours of details on potential succession. According to people familiar with the situation that Bloomberg reporters have spoken to, Bank of America is planning a shakeup of its senior leadership ranks in a move that will narrow the slate of leaders who could one day succeed Brian Moynihan. One of the people that's at the center of that discussion right now is Jim DeMare, who runs the firm's trading business, Katie.
Absolutely. You're seeing promotions for other senior leaders as well, but it seems like Jim DeMare really in focus here. Succession has been a bit of a black box at Bank of America. We'll get you some more details on that and have a full breakdown of all of today's market action right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld, taking you through to that closing bell with a global simulcast. We're joined right now by Carol Massar and Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms as we keep an eye on the market and two developing stories here as we get closer to the closing bells. One involving the agriculture company Corteva, a report by the Wall Street Journal that they may actually be planning the potential of separating out their businesses into two. Those shares moving higher, and a scoop by reporters here at Bloomberg News as now Bank of America is said to be planning a shakeup of its senior leadership roles in an effort to narrow the slate of potential successors to longtime CEO Brian Moynihan.
Yeah, it's a busy Friday afternoon. And as you said, Romain Corteva shares up almost 3% on that news. Bank of America has been kind of little movements in today's session, a little bit higher at one point, a little bit lower, just down about 0.25%. But yeah, companies are certainly making changes at their companies.
I know there's always...
Tim is flummoxed by
I'm
this.
flummoxed a little bit because we're seeing, in the one sense, we're seeing companies break up, like, a Comcast, for example, spin off an asset that's not performing as well. And we see that all the time. In another sense, we're seeing companies potentially combine. Paramount Skydance and Warner Brothers Discovery. We see consolidation there. But on the big picture, we're seeing a lot of companies separate right now. It makes me think of a few years ago, GE breaking up into 3 different companies and kind of starting this wave of moving away from these large conglomerates and really spinning things off into seperate companies.
Well, you look at the price performance afterwards. Spinoffs are very popular among investors as well, companies and investors.
All right. We're going to keep an eye on those stories, but let's walk you through real quickly what happened in financial markets today. A mixed bag for most of the major financial markets. It takes a while for these numbers to settle, but as you look at the S&P 500, it looks like it's going to close the day relatively unchanged, but it is with the down arrow. So that streak of gains and that daily win streak that had been trying to stretch into a 5th day, that is now over. Down about 3 points here on the day, but still holding just below 6,600. The Dow Jones Industrial Average pulling back by 273 points, or 0.6%. But the NASDAQ, both the composite and the NASDAQ 100 higher on the day. And we should point out for the NASDAQ 100, this is actually, I believe, going to be the 8th straight day of gains that we're seeing for the NASDAQ 100 and the 3rd straight day of record highs. The Russell 2000, though, it's sitting this one out in a big way, down 25 points or 1%.
Yeah, really defining, I feel like, tone to the market this week. If you look at the major averages and what we've seen. But I'm looking at what happened today, and it felt like investors taking a bit of a breather. 385 names in the S&P 500, Katie, lower in today's session, 116 to the upside.
Well, let's talk to the circle about it and see what the colors show. You can see that there is kind of an even split when you look at it that way, but on the absolute sector level, you had 4 in the green, 7 in the red. What did do well today, as you can see, technology, that was reflected in the NASDAQ 100 as well. Utilities also having a good day, but then you take a look at what didn't do too hot. Healthcare, materials, industrials leading us lower on this Friday.
I'm sorry, when you look at the circle, it speaks to you?
It does.
Okay.
Yeah, I just sort of open up my heart and my ears, and it tells me what happens.
And you're the only one who can hear that.
All right. Let's get to some of the individual gainers. Warner Brothers Discovery, folks, adding on another 17% in today's session after about a 29% gain yesterday. The stock I'm looking at, I think it's up about 56% for the week overall here. And again, this is just building on, since we've got that report that Paramount Skydance, the Hollywood studio taken over by independent filmmaker David Ellison, has said, or is said to be preparing a bid for the company, according to those in the know. So this stock, I think, your number one gainer in both the S&P 500, NASDAQ 100.
I find this fascinating, though. I mean, the run up.
Part?
I mean, you mentioned the 50, it's like 56% jump, but the idea is that you're basically saying that the combination, or more importantly, the premium that they would pay, investors think it's going to be about 56% more than what it was earlier this week?
It's pretty amazing. I don't know. I still think, right, you'd buy something and then sell off some parts. It is a gamble, right? Especially in this environment where you see
how do you have CNN
such a crowded space?
CNN and CBS coexisting? Like, I don't know if there are news challenges.
Yeah, I hate to break this to you, Tim, but...
What?
Never mind. Go on. I don't want to get myself in trouble.
It's a good question.
I've already gotten in enough trouble this week.
Yeah, you canceled our weekly lunches. Anyway, go on.
Different networks, different audiences. Okay, all right, whatever.
Yeah, I mean, I think there are regulatory. There are. I think there are regulatory questions about this.
Is there any more?
Are there?
I don't know that there is. There's so many.
For David Ellison?
Content.
Okay.
What are you saying?
Right.
You're going to get into trouble.
Romain.
I think you should stop talking now. All right. I don't want you to get into trouble. All right. Tesla, also an outperformer and a top gainer in some of the major equity averages today, up about 7.4%. Investors definitely watching to see how quickly the company can expand its robo-taxi service to other states after it launched in Austin in June to a small group of users. And I got to point out, if you haven't watched it, you should definitely check out the BTech team's interview with the chair of the Tesla board, Robin Denholm. They talk succession, the massive pay package. Basically, they're all in on Elon continuing to run this company through what they say kind of are disruptive times. So I think that's an interesting one. Micron Technology, I might have been a record close today, so forgive me for not getting that in place, but it's up.
Do you not check this stuff before you come on?
You know, I get a lot of, I don't know about you, but I don't have minions like helping me do stuff.
Well, let me tell you, I have the best minions in the business. Thank you very much. Which is why we get lunch for them every day here at Bloomberg Television. And yes, Micron, record high, best day since going public back in 1984.
I want to give you something to say, otherwise you would feel so left out.
How dare you call them minions?
Micron Technology up about 4.5%.
You know they can hear you.
Analysts yesterday, I know, but they aren't the minions I'm talking about. Analysts touting the chip makers' growth potential in the data center market. Keep in mind, this one reports September 23rd. We've seen Citi boosting its price target. There's a lot going on. I think the stock was up about 19-20% for the year. Just mentioning Gemini, because if I don't, Romain's going to say something. It is up an IPO, another one in the crypto space, up 14% here at the close, and Corteva, because we just talked about up about 1.8% on that Wall Street Journal report that maybe that it could separate into two separate companies.
Can I just also honorable mention, I know Tim has to get to his decliners, but BlackRock Coffee, you missed it. I mean, you mentioned that. I mean, I had a IPO at 20, closed today at 27.67. Great day.
Not the Larry Fink BlackRock Coffee.
Yes, it's like a Dutch Bros drive-through coffee, Portland, Oregon based.
Now, have they spoken with Larry Fink about this? They're okay with this?
I don't know about
There's
that.
There's a space in between black and rock, so it differentiates them.
Finley is not
this is why I should have been a lawyer. Lawyers always make out.
My gainers list.
The people.
Are you going to let Tim talk now? Thank you. Go ahead, Tim.
The people want to hear the decliners. I want to start with the second worst performing stock in the S&P 500 today, mRNA. Moderna down 7.4%. Shares fell after a report from the Washington Post said that health officials in the Trump administration plan to link COVID shots to the deaths of around 24 children in a presentation to advisors to the CDC next week. Shares down 7.4%. RH ended up falling 4.6% in today's trade. The company did cut its revenue forecast for the full year. The effect of tariffs, the delay of its seasonal catalog. Gary Friedman, who has been outspoken about tariffs over the last few months, told analysts that the industry needs to offer discounts to stay afloat due to the weak housing market. Yeah?
Was that his full quote?
No, that wasn't his full quote. God forbid they throw another tariff on furniture, Friedman said on Thursday night. Someone has got to come talk to us, talk to me, call me. I'll run the biggest luxury home brand in the world.
That was verbatim?
That was verbatim, yeah.
I love that energy.
Yeah. Shares fell, once again, 4.6%. And finally, a check on Open Door after the week that was. Shares up 80% yesterday, fallen a little bit today, down 14%. Still the most actively traded stock in the index. The excitement around the company, or at least the trading around the company, continues.
All right, let's take a quick look at yields here. It was an interesting week for yields because we talk about the idea of the trend line sort of reversing just a little bit. Long-term yields lower for a second straight week to the lowest level since April. And then we should point out the short-term yields rising for the first time in 5. Now, overall, what you're looking at there on your screen are the daily moves, and they all are higher. And that, of course, is a setup, Carol, as we head into the Fed's two-day policy meeting that starts on Tuesday.
Oh, we have no time for chats, huh?
No time for chat.
What did you want to chat?
We chatted already, Carol, about your gainers.
There's so much more to say, though, you know?
I'm so sorry.
That's okay.
Carnival
Next
has
time.
a new non-alcoholic.
Are you here all 5 days next week? Or?
We are.
So no.
Oh,
all right.
Oh my goodness.
Yeah, we're here.
Yeah, we're here.
Oh,
Yeah,
okay.
we're here.
All
But
right.
it's Fed Day on Wednesday, guys.
Yeah,
Yes.
so kind of not here.
So,
well,
yeah.
until the close. Until we meet up with you, lovely folks.
Most consequential Fed day.
Full disclosure, I don't believe your team has any minions. Because I really, you know.
All right.
All right.
Say goodnight, Gracie. Come on.
All right, one minion just yelled at me. All right, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Radio. Guys, have a good and safe weekend. Of course, Katie and Romain continuing there on the TV side, and Tim and I right here on Bloomberg Business Week Daily.
We have a lot more coverage coming up here on Bloomberg Television. A look at the week that was a golden week, specifically for gold, with the commodity surpassing its inflation-adjusted peak set more than 45 years ago. A discussion up ahead. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. Romaine Bostic here alongside Katie Greifeld with the NASDAQ 100 stretching out to an 8th straight day of gains, 3rd straight day of record highs. But we should point out, Katie, the S&P could have cooling just a little bit here on the day. But there was some massive outperformance this week outside the U.S. In fact, if you take a look at global stocks, they hit a record high both with and without the U.S. involvement in those indexes. In fact, when you take a look at emerging markets, the main index that tracks that, the MXEF, outperforming on a weekly basis the S&P for a 2nd straight week.
And that has been the story all year, really, that rest of world outperformance versus the S&P 500, which, of course, is at all-time highs. But let's take a look at some individual movers, some of the big gainers on the day. Of course, had to highlight once again Warner Brothers Discovery and Paramount Skydance. These were your 2 biggest gainers in the S&P 500. We know the story there that Paramount Skydance said to be preparing a bid for Warner Brothers. That is boosting both stocks. And then I wanted to throw up Oracle as well. We know that they had a blockbuster earnings reaction, soaring 35%, I believe it was on Wednesday. Some of that cooling, Oracle shares down 5%.
All right, we want to get back to one of the stories that we broke just a little while ago, this involving Bank of America. Bloomberg reporters, speaking to people familiar with the situation, have learned that the bank is planning a shakeup of its senior leadership ranks, potentially trying to set up a succession plan for CEO Brian Moynihan. Joining us right now is one of the people who broke that story. Sri Natarajan joins us here in Studio 2. All right, Sri, let's get to this. I mean, Brian Moynihan has basically been there for like, what, 15, 16 years now. There have been a lot of questions about how much longer he would stay on, and more importantly, what type of bench is behind him to succeed him when he's finally, or I guess when the board is finally ready to let him go.
Absolutely right. Brian Moynihan took over as CEO of Bank of America in January 2010. He's been there for 15 years. Outside of Jamie, and Jamie is Jamie, by the way, also Jamie Dimon at JP Morgan has already identified who his slate of likely successors will be. Outside of that firm, pretty much every other senior leader, one of their peer banks, has left the stage. Lloyd Blankfein, Michael Corbat, Vikram Pandit, if you look at 2 names out of Citigroup, James Gorman at Morgan Stanley. So for 15 years, Brian Moynihan has been the CEO. And that's why whenever there is talk of a leadership shakeup, especially at the senior ranks, we wonder what message this sends. And we have heard that they have been discussing promotions for their markets heads, Jim DeMar, and also some other leaders that could, at least in our opinion, narrow the slate of potential leaders who could replace Brian Moynihan, who, by the way, has also said he doesn't want to go anywhere till the end of the decade. So he wants a 20-year run atop Bank of America.
The end of the decade, we are firmly in 2025. Tell us a little bit more about Jim DeMar. He, of course, runs the firm's trading business, as your reporting identifies, potentially really moving up in the league tables here in terms of who could be the next Brian Moynihan. Give us a little bit of detail about him.
DeMar is in an interesting position. He's had the senior-most role in that markets business, in that trading operation, since the departure of Tom Montag back in 2021. Tom Montag at the time was not just the head of the markets business. He had oversight over the deal-making business as well. He was the chief operating officer of Bank of America, and in some sense, the de facto number 2. But after he left, instead of moving on to, say, the board of Bank of America, he went and joined a rival bank, Goldman Sachs, his former employer, and joined the board there. So that senior role, in some essence, was left vacant, and that's why you've had a number of people who had been directly reporting into Brian Moynihan. So it'll be interesting to see when Bank of America concludes these planned talks and identifies the next set of leaders, who they would be, and how it positions them for the future.
I don't want to get you in trouble, but I'm curious as to how clean this can be, because when I hear you say that Moynihan wants to stick around to the end of the decade, so another 5 years, more or less, if you are waiting in the wings and you're good enough to replace him, why would you stick around?
Look, that's a very good point, and that is the criminology that is being discussed in sort of inside of Bank of America as well. Yes, you might elevate a few leaders. Say it includes Jim DeMar, who's 56 today. In 5 years, if for 5 years Brian Moynihan does not leave, is Jim DeMar necessarily the best person positioned to be the next CEO at 61? At 61, if he were to be picked to be the CEO, he would be one of the oldest first-time CEOs of a major bank. Some of the other more senior leaders are even older than DeMar. So that does raise some interesting questions. You will get a nice, comfortable paycheck, and you can never discount that. And you have the certainty of being at the helm of one of the biggest banks in the country in the world. So that is an important role. But does it necessarily guarantee you a shot at, say, the CEO's role? Oof, not sure about that.
Okay.
Well, sounds like a fun question to try to answer on your own. Sri, great reporting as always. That is Bloomberg's Sri Natarajan. And remember to tune in to our upcoming interviews at Bank of America on Wednesday. Bloomberg Surveillance will speak with Jim DeMar and Brian Moynihan. Certainly will be some interesting conversations there. But speaking of potential market catalysts, we're less than a week away from the Fed's next interest rate decision. Chris Cain of Bloomberg Intelligence is here now for another edition of Factor Friday. And Chris, as we kick off what could be another easing cycle by the Fed, what should we be watching for when it comes to trying to estimate or guesstimate stock performance?
Yeah, Katie, I mean, that's definitely a pertinent question right now. Like you said, the Fed's going to start likely a cutting cycle next week. So, surprising to no one, stocks do very well during cutting cycles. When we looked all the way back to the 1970s, they do about 15% annualized, during easing cycles like we're about to embark on. But we did see a big difference between easing cycles that coincide with recessions and ones that do not coincide with recessions. So maybe surprisingly, even when we have an easing cycle and a recession, stocks still do well. They do about 11% annually. But if we have an easing cycle with no recession, that jumps up to 25% per year that stocks do, at least historically. So I'm not smart enough to know if a recession's coming, but if the Fed could, thread the needle here and ease rates without a recession, we could really be in for a very good setup for the rest of the year.
Yeah, well, don't worry, Chris. Most economists aren't smart enough to make that call either. But you do keep a track of economists' expectations, particularly around the Fed cuts here and the dispersion in those estimates. I am curious as to what that is telling you specifically as it relates to the stock market.
Yeah, this is really interesting. So again, we were trying to look at in easing cycles, what really matters for very outsized returns. Another thing that we found is when the dispersion of economist estimates for what the Fed's going to do is wide, and then the Fed starts an easing cycle, stocks do very, very well. When the economists are kind of like in agreement that the Fed's going to cut, they do less well. And you could kind of think about this like, if the economists are really, dispersed in their opinion, that the market's probably not pricing in that the Fed, cut's going to come, hence why they do so well. So where are we right now? In the beginning of this week, actually, a lot of the economists' expectations were kind of all over the place still. So we still had very high dispersion. I thought that it would really set up well. Now, after the CPI print on Wednesday, almost all the economists kind of like got on sides, and they're all, expecting at least 25 basis points on Wednesday. So we've really seen a shift in that dispersion from high dispersion to low as far as economists' expectations this week, thanks to CPI.
And Chris, before we let you go, we know that the Mag 7 has a big influence on the S&P 500, but how does it differ when we're talking about an uptrend for the index versus a downtrend?
Yeah, so there's no doubt that a Mag 7 has a huge influence. I mean, that's just math, right? I mean, they're the biggest companies. It's a market cap weighted index. So I'm not here to say it's not influential, but you do see a large difference in the influence during up and down markets. So I won't bore you with the math, but basically when the market just generally is going up, the Mag 7 could explain about 50% or so of the S&P 500's movements. When it's going down, it explains about 75%. This is very consistent with other things that we see. Like you see market volatility in general go up when the market goes down. You see stock correlations, like how much do stocks move together or not. They start to move together, when the stocks go down as well. So you see a big difference there. And I think the big takeaway is in a bull market like we are right now, you can get returns from other places. You're not dependent on just the Mag 7 in a bull market.
All right, Chris Cain over at Bloomberg Intelligence. Always a very sentient and great breakdown here of what's really driving the market over the past few days. Of course, equities had a pretty good run this week, but so too did gold. A fourth straight week of gains here and maybe a golden opportunity ahead in commodities. We're going to discuss with Will Rhind, founder and CEO at Graniteshares, when we come back. This is The Close on Bloomberg. We want to go back to that breaking news on Bank of America. Bloomberg reporters had discussed the idea that Bank of America was narrowing its top leadership, shaking things up just a bit. And now it looks like we are getting confirmation of that. Bank of America, the redhead crossing the Bloomberg terminal, is promoting Jim DeMar and Dean Athanasia to be co-presidents of the company. Of course, Jim DeMare leads the trading unit, and Dean Athanasia leads the regional banking unit. We don't have a lot of details on this just yet, but what we are learning right now is that Jim DeMare and Dean Athanasia have been elevated to be co-presidents. We're also learning about some other elevations, particularly to the CFO role. You need us to give us a second here. We're going to try to get you some more details on this, but it looks like a big shakeup at the top of Bank of America.
Yeah, we will continue to follow this story, but let's go back to the market action, of course, that we saw this week, because gold surpassing its inflation-adjusted peak set more than 45 years ago, adding to its nearly 40% rally this year. Will Rhind, he is founder and CEO at Graniteshares. He joins us now to discuss the commodities surge. So, Will, it's not just the price action, too. It's investor demand. You do have those flows chasing that performance, and I know that you've seen that in your lineup as well.
Yeah, that's right. It's not just a price story that we've seen strong support in terms of inflows into the ETF market, but I think more broadly as well into the gold market writ large, with central banks continuing to buy, continuing to be strong, and then retail investors as well in the physical bar and coin market. So it's sort of strength all around for the gold story.
The strength all around for the gold story, Will, and I am curious as to sort of what drives it longer term. I know there's been a lot of discussion as of late about the rate situation and inflation, but this is kind of a run-up that sort of, to a certain extent, I think, sort of predated that conversation.
Yeah, I think what's happening is that gold has really become the de facto asset that is alternative to the US dollar. And while gold was certainly in the running for that position before, it's really cemented itself now, in my mind, as the de facto, non-dollar asset, and surpassed the euro in terms of total value held by, central bank holdings, etc. So gold is really in that place. I mean, to a lesser extent, we see a similar phenomenon going on in the Bitcoin market or in cryptocurrencies. But, this is about alternative to the dollar, and, gold has cemented itself at the top of the tree here.
Well, Will, I'm glad you went there, because that's something that I've been watching as well. Not just the flows into gold, but the flows into Bitcoin. It seems like demand for one or the other hasn't dented the appeal of the other asset, that these two can basically exist peacefully.
No, absolutely. And of course, every time the market ticks higher, I mean, remember, we are at all-time highs after all, that, investors' need for diversification also increases, and people do get, start to get more nervous about the market. And while the data for the most part is still very strong and the story for US equities is strong, there are a little bit of, there are some concerns out in terms of the CPI data, while is sort of under control from an official perspective, is higher than I think the Fed ideally wants it to be. The labor market, there's significant revisions there, so the market seems to be softening on the labor front. And then we're entering now into a phase where we're expecting the first rate cut, next week, but potentially we could get more coming into the end of the year. So this is a good setup for the gold market. And again, we mustn't forget that there are still significant geopolitical tensions out there, which are already, in addition, providing support to gold.
All right, well, we have to leave it there. Really appreciate you taking time. Will Rhind, founder, CEO at Graniteshares. Now, we do need to get back to that breaking news involving Bank of America. Just a little while ago, Bloomberg reporters had cited people familiar with the situation about a potential shakeup at the top of Bank of America. Bank of America now out with a statement saying that they have named Dean Athanasia and Jim DeMare to serve as co-presidents of Bank of America, and the CFO will now also take on the title of Executive Vice President. Let's bring Sri Natarajan back into the conversation, who broke that earlier story, to kind of break it down. All right, just kind of, I'm a little confused here. Right now at the top, we're talking about Brian Moynihan, CEO. Joe DePinto, where does he? He's president.
Well, now you have two new co-presidents.
Is Joe DePinto in part of that?
No, it's Jim DeMare and Dean Athanasia, who will be the two co-presidents of Bank of America. The other person, too, have gotten a new title. Unclear to me if it's necessarily a promotion, is CFO Alistair Boatwright, who also will have the title of Executive Vice President. But actually, just let's read through their announcement, where they themselves say that the key part here is Athanasia and DeMare will drive company-wide initiatives focused on long-term growth. And what this will do is the company's management team on the 8 business lines will now sort of report into this new slate of leaders that the bank has identified. And it's an important time for Bank of America. They're hosting an investor day after a gap of many, many, many years in November. And CFO Alistair Boatwright just this week talked about the frustration at the Bank of America management level about the relative value gap that they've noticed in the market. And they are right to notice that. Bank of America is the worst performing big US bank in the last year. In the time since the Fed started its interest rate hike cycle, which was back in March 2022, Bank of America has returned some 34%. Its stock has gained some 34% if you include reinvested dividends. The next worst performer has delivered 78%. So clearly a gap has grown. Clearly the market is not convinced that what's going on at Bank of America is the best bet in the banking sector. And this goes back to Brian Moynihan's leadership. When he took over as Bank of America's CEO, he had to right the ship. And that's what he did in the first 5 years, and he delivered it. There were critics at the time who were not sure he could do it. He had a legal background, and could he fix Bank of America through the storm of the global financial crisis? He did it. The 5 years after that, say 2015 to 2020, it was steady going at B of A, but they seem to have lost ground in the last 5 years. Look at the gap that JP Morgan has put between itself and the competition, but especially Bank of America now relative to 10 years ago. So perhaps to the market, perhaps for analysts, perhaps for investors, this new slate of leadership could be reassuring, could be a sign that they will re-energize their efforts to convince the market that they have a narrative to put forward there, and they should have a better multiple on their stock than what the market is giving them right now.
Right, and JP Morgan, to your point, hitting all-time highs this week. Let's talk about Brian Moynihan, though, because in the letter that he sent out, also saying that my focus as chair and CEO of the company remains the same. Our management team remains the same. And this gets into what you were saying, that this is a man who wants to lead this bank for 20 years. He's not there yet.
Look, and that's the important part. I think we should not mistake anything in this announcement as an indication or a signal that Brian Moynihan is ready to exit stage left. He's previously said he wants to stay through the end of the decade. If that remains his intention, and if that's where BofA ends up, that is Brian Moynihan as CEO through 2030. And therefore, you have to ask the age question. Jim DeMare is 56 today. Does he wait to be CEO in 2030 when he'll be 61? Dean Athanasia is 59. He'll be 64 then. So yes, this does identify the new prominent leaders under Brian Moynihan at BofA today.
Just on that point, though.
Can they become CEO? I don't know.
And just on that point, though, and I don't want to seem ageist, but if you go on the Bloomberg terminal, you can see all the management, the top management, and their ages. And they're all over 50, more or less. So I think there's one outlier who's still in their 40s. But this is certainly a seasoned, if you will, management lineup. Has there been any discussion about looking for outside talent?
Look, seasoned management lineup, seasoned board lineup as well. I remember when David Solomon took over as CEO of Goldman Sachs back in 2018, he was 58. And at that time, the stat was he was the oldest first-time CEO at Goldman Sachs since it went public, or even going back before that in terms of senior leadership. So I would be surprised if the conversation is around looking for outside talent, because outside talent always signals to the market that the bench we have is not good enough. That is not the signal that Bank of America is sending. That is not anything that Brian Moynihan has hinted at, wants to do. Yes, other banks have thought about it and done it, Wells Fargo notably, but did Wells Fargo need to do it? Absolutely. They were in a world of trouble, and that's why they had to bring in Charlie Scharf, and the bank is in a better position and better footing today. But Bank of America does not have to worry, at least at this stage. No one's girding for change in terms of bringing in outside talent. Not necessarily are they saying Brian Moynihan needs to leave the company right now, but they do need to lift performance.
All right, Sri, great to have you on set with us breaking down this Friday news dump. That is Bloomberg's Sri Natarajan. And remember to tune into our upcoming interviews at Bank of America on Wednesday. Bloomberg Surveillance speaks with Jim DeMare and Brian Moynihan, and you will not want to miss those conversations.
And we want to continue this conversation about C-suite leadership with Nina Trentmann. She's a senior editor at Bloomberg Editorial who helps to lead our coverage with our columns on what's been going on in the C-suite, particularly with CFOs. And I think Sri kind of raises a good question about the idea of succession planning, or in the cases of some companies, the lack thereof. And also the age of talent that you have on your bench. And you don't want to be too ageist, but there always is this idea that as you pick a new leader, you want to make that he or she has the capability to be around for a long time, should they actually prove their worth.
Yeah, at least for a few years. The data certainly indicates that we've looked at recently that for CFOs, they're on average a bit younger than their CEOs, but then also 10 years for CFOs tend to be a bit shorter. They're about 5 years. So many CFOs are promoted to this position in their like late 40s, early 50s, mid 50s. But yeah, it's an important point, specifically also this point that he raised about the strength of the bench. And do you have enough people that can succeed your own CFO at some point? It's an important point also for CFOs at some point in their career to say, okay, well, I'm not going to do this forever. Who is going to succeed me? So
yeah, absolutely. And let's talk about what CFOs right now specifically are doing with their cash. There was such an interesting story on the terminal this week that you look at how companies are managing their cash holdings, specifically moving them into longer term securities. This coming as we count down to that Fed decision. What can we read into that decision to go longer term?
Yeah, I think it's an interesting finding, this data point that shows us that since the beginning of the year, companies, specifically very cash-rich companies in the U.S., have reduced over this time period their cash holdings and also other very liquid holdings, so money market funds and those kind of things, towards corporate bonds and also T-bills, so a little longer duration assets that offering potentially higher yields when the Fed moves and lowers rates, which is interesting to see because it's not as if corporate treasurers and CFOs usually are sort of the ones that are leading the pack on this. So like they are not front runners. They're very sort of cautious when it comes to that. But it's an interesting indication because it shows that they're expecting also that the Fed will cut.
I'm intrigued by this. I'm also intrigued by just the level of cash that we're seeing right now on some of these corporate balance sheets. The idea that it's a little bit subdued, I guess, based on historical averages. And I'm curious as to why, because all year long we've been talking about this big CapEx spend, and certainly, at least in the tech space, maybe not elsewhere, this big CapEx spend. So I would think that given all the promise of AI and technology, you would want to have that cash ready to go and not necessarily locked up into a long-term instrument.
Yeah, but also long-term in this context is maybe not what we would think is long-term because the average portfolio length for this portfolio that we looked at is still about 8 months. So yes, of course, you cannot necessarily tap into that tomorrow or next month. But if you have visibility into what you think you will need in 6 months or 12 months from now, it might be an option to say this is a better yielding asset than money market funds where returns will certainly come down.
All right, Nina, really appreciate your time. That is Bloomberg's Nina Trentmann. You can catch Nina's coverage by subscribing to the CFO Briefing newsletter at bloomberg.com/newsletters.
I wonder what our next one's going to be about.
I know. Well, you can subscribe right there. And
I'm already subscribed.
Well,
I subscribe to your newsletter too, Katie.
I appreciate that. It came out at about 2 p.m. today. Anyway,
I haven't read it yet.
For more on the Fed's upcoming decision, I'll read it to you in the break. We're joined now by Vincent Reinhart. He is chief economist over at BNY Investments. It's great to have you with us, Vincent. So clearly corporate America expecting Fed cuts here, and it seems like we're all but certain we're going to see 25 basis points next Wednesday. But it's all about the messaging, isn't it? What tone do you expect that Jerome Powell will actually take at the press conference?
I think you can get a good idea on the tone about the way they signaled the policy action. Chair Powell essentially told us that they would ease at his speech at Jackson Hole, but he wasn't really that explicit. Why? Because probably he has colleagues who are restive. And that suggests to me that it'll be a mixed message, a hawkish form of cut. With they cut the funds rate 25 basis points, but they signal with the summary of economic projections that at least some of them are not that comfortable with cutting much more.
Well, you talk about that restiveness. I have to imagine one of the factors there is that you have folks in the room who are being considered to be the next Fed chief, Vincent, and I wish I could be a fly on the wall, but it should make for a really interesting conversation.
Bad news is, been to 100 FOMC meetings or more. They're really kind of boring. It's the stuff on the sidelines that you'd probably be more interested in. But for the meeting itself, I think the core issue is you're exactly right. The people writing down their forecast and the summary of economic projections are doing it for a lot of reasons and not necessarily about forecasting the economy. They're signaling about their availability, if they are headed in the same direction as President Trump wants, i.e. much lower rates. They might, some of them also alternatively might be signaling about what they think an appropriate conservative central banker should do. That means they'll be signaling high rates. That suggests to me that there's going to be a very wide dispersion in the dot plot this time around in the summary of economic projections.
I am curious, though, when we talk about what is going to go on behind that room, and obviously the complexion changes, we're going to presume that Myron potentially might be in that room, assuming he gets the Senate confirmation. There's also the potential, depending on the court cases, whether Lisa Cook is going to be in that room. And now we're talking about the potential overhang of a public announcement for Jay Powell's replacement before, months before he's actually scheduled to leave. Does that make it harder, Vincent?
So it makes it harder for a couple reasons. Number one, it makes it harder to read the summary of economic projections because some of those dots are by people who won't be there. And some of those dots, as Katie suggested, are by people who are signaling about their availability for the top job that's not going to get filled. So the dot plot is less about a forecast and more about messaging. Second, it erodes Chair Powell's soft power. The way the chair shapes the committee isn't because he's got a lot of rule authority written down in the law. He's got soft power. He can influence the committee by promising that if you go my way next time, I'll really listen to you and I'll give you a front seat. I'll pay a lot of attention to you. Or he could be encouraging in lots of different ways. For him, his calendar pages are turning. He doesn't have as much soft power.
Yeah. I am curious to also, too, just about the synchrony or lack thereof between central banks right now. Earlier this week, we heard from Christine Lagarde. Of course, the big headline there, out of her mouth at least, was that the disinflationary process is over, which, of course, the markets meant to, interpreted that the rate cuts are over as well. Meanwhile, here in the U.S., we're potentially about to embark on a rate-cutting cycle. Does that lack of unison matter anymore?
So it matters a lot if you're a holder of the foreign exchange currency, right? The foreign exchange of the dollar is very much influenced by the rate differentials. The differential sequence really does matter, although basically the dollar story over the last 9 months has much more been about tariffs, retaliation, and the U.S. attitude towards being the safe haven asset. So yeah, it matters at the margin. The big message to take away from that is central banks don't coordinate. Sometimes they move together, but that's just because their economies are all responding to the same thing. They look to their domestic objectives. They're going to go their own way if that's what meeting their domestic mandate requires.
And I hear what you're saying, that there's no lockstep here. Of course, it's not like the central banks are coordinating, but even still, you think about the impacts that the Federal Reserve's actions have. How much does what the Fed does on Wednesday and the meetings to come matter for the rest of the world?
Yeah, well, what did I say? I said, they respond to their domestic considerations given the global economy. The U.S. has an enormous footprint in the global economy, and sometimes what the Fed does gives them cover. Sometimes what the Fed does is make life harder. I think for the ECB, it's a little more difficult. If the Fed does something that would otherwise tend to weaken the dollar and strengthen the euro and make that disinflation problem a little more severe for President Lagarde.
Vincent Reinhart, chief economist over at BNY Investments. A nice setup here to a big meeting next week. Katie Greifeld, the two-day Fed meeting Tuesday and Wednesday. And of course, we'll have full coverage Wednesday afternoon, team surveillance with the Fed Decides special that afternoon.
Yeah, looking forward to that. But let's say goodbye to this week and look at some of the notable movers on the week. We start, of course, with Warner Brothers Discovery. Those rumors surrounding it, of course, with Skydance Paramount. You can see that Warner Brothers shares up 56% for this week alone. Oracle, too, having a banner week, up about 25.5%. Just amazing movement there.
Yeah, best week for Oracle going back to 99. But take a look at Synopsys, kind of moving in the opposite direction here. This is the chip design software maker. Remember, they had their biggest, worst loss, I think, ever back on Wednesday here, a big part of the reason. And I was taking a look at Starbucks. I was curious about this 8-day losing streak for this stock right now.
Yeah, what's going on?
It's had a lot of issues here. I mean, Brian Niccol, of course, trying to turn it around. We were just talking to a successor over at Chipotle. Of course, he's only been on the job for less than a year, so too has Brian Niccol. But it'll be interesting to see if he can turn that ship around.
All right, yeah, not even the cold foam protein lattes could help. This is the close on Bloomberg.
The board's responsibility is to look at who the CEO is for the next period of time. And we believe that Elon is the right CEO for Tesla over this transformative period of time. And our view is he's a generational leader. There aren't any other people out there like Elon.
And that was Tesla's chair, Robin Denholm, insisting that Elon Musk is the only person who can lead the company's next phase. Bloomberg Tech co-host Ed Ludlow conducted that interview. He joins us now. So, Ed, I think often about the Elon Musk premium that's built into the stock, whether or not it exists. It seems like Robin Denholm certainly believes it exists. Is there truly no one other than Elon Musk who could lead the next phase of Tesla's growth?
The honest answer is we don't know, because at least Denholm confirmed that there is some sort of plan already in place when it comes to succession. So if Elon Musk were to depart Tesla tomorrow, they seem to have a sense of who internally might be able to step up. But this also isn't like a new idea. It's long been in the boilerplate of regulatory filings that if Elon Musk were to leave Tesla, it would have an adverse effect on these big picture long-term goals that they have. She kind of was acknowledging that internally they do see talent, but remember that this proposed pay package is a 10-year deal, right, on paper, and the last two tranches of the comp directly correlate to Elon Musk's participation in finding his successor, be that internal or external. And that's going to be, later in the decade, a really interesting part of the story.
All right, Ed Ludlow is the co-host of Bloomberg Tech. A great sit-down earlier today that he and Caroline Hyde had with Tesla's lead board member there. A lot of questions here about the future of Tesla and about its leadership, but underlying all that, of course, just a lot of questions about how hard it is to start a car company. And we want to stay in that space right now. It's time now for our next up segment. This is where we highlight the entrepreneurs and trendsetters moving the needle in the business and the economy. And today's featured guest runs a luxury electric vehicle startup with big plans for it to be 100% American-made. Pleased to say joining us live here in Studio 2 is Kristie D'Ambrosio-Correll, co-founder and CEO of Dacora Motors. Great to have you here.
Thanks for having me.
All right, so I mean, we should point out with Tesla, obviously we know Musk didn't found the company, but the guy who did obviously had to be kind of nuts to try to start a car company. There have been so many people in the modern era that have tried to start a car company, particularly here in the US, with varying degrees of success. Talk about, A, why you think you wanted to do this and why you think you're going to succeed.
So for me, it really all started under the hood with my dad. So I'm a big car lover. My dad loved American cars, and so cars have been in my blood a long time. And it's always been a vision of mine to start a car company, and not just one here in America, but an ultra-luxury one. So one to compete with the best of the European market.
And so when we talk about ultra luxury, we're talking about a price point of about $500,000.
Correct.
So this is a very targeted audience you're going for.
Correct.
How have you done so far with regards to generating interest, generating pre-orders?
Yeah, we've had a fantastic reception thus far. We're actually sold out of our first year already in terms of pre-sales, selling into our second year. But really, it's all about gaining trust and relationship building with our client base.
I want to talk about why you decided to go specifically with EVs, to make this an electric vehicle company. We know that outside of the ultra luxury cars that don't cost $500,000, that EVs have had a rocky couple of years in terms of uptake. What's the outlook when it comes to this stratosphere?
We didn't set out to build just an EV. We set out to build the best ultra-luxury vehicle, and it made a lot of sense to go with an electric powertrain. In the luxury market, you're looking for silence above all else, so peace and quiet in your interior. You're looking for performance, but not one that necessarily has to roar, and you're looking for ease of maintenance, and all of those things come standard with EV.
And taking a look at, your notes that you sent over to our producers, you do point out that you are 100% American made. And we're having this conversation at a really difficult time for the big three automakers and even for Tesla on some levels when it comes to the tariff picture, the trade picture. How insulated are you from that conversation?
Yeah, so because of our price point and because of our volumes, which is much lower than the big three, we do have the benefit of being able to source domestically for many components that they can't. So we are fairly insulated in that respect.
We should point out, you have an interesting background. I mean, I think your most recent gig was at Mirror, which is now owned by Lululemon.
Correct.
You've worked from some other startups, as well as a few other big companies as well. What sort of is the link between your management experience, or an entrepreneurship experience for that matter, in those companies, and what is now a luxury car company?
Yeah, I really learned how to create technology for people, and not just technology for technology's sake. And I think sometimes technologists get lost in that message, and they try to produce what they think the world wants, not what customers actually want.
Once this hits the ground, and just to be clear, I mean, when are you expecting this to people will actually be behind the wheel driving down the street in one of these?
Yeah, so we do expect first deliveries to be in late 2027, early 2028.
What planning have you done for the next phase, which is the maintenance and the sort of the car ownership process? Because it's one thing to build and sell it, but of course you also have to be there through that ownership process for servicing as well.
Absolutely.
Yeah.
So for us to service, everything will be done white glove on site. It's something I am familiar with from my background and in other companies. Being able to do that across the country is something that I do have experience with.
All right. Well, this is real fascinating, Kristie, and I'm really curious to see how it goes here. We haven't had a new entrant into the market, and interesting you carving out a niche there, that ultra luxury market. It's out of my price range. I don't know, but I'll be happy to sit in the back seat of one if I get a chance. Kristie D'Ambrosio-Correll is the co-founder and CEO of the new luxury car maker, Dacora Motors. All right, stick with us. We're going to set you up for what to watch over the next week when we come back after the break. This is Bloomberg. Well, it was quite a week on Wall Street, Katie Greifeld. Stocks did manage to eke out record highs on the week, but of course a lot of that could change, there I am, over the next 5 days next week. Let's start off on Monday, and we're going to actually start off overseas here with some economic data out of China.
Yeah, absolutely. And then we do get some U.S. data, U.S. Empire Manufacturing. That brings us to Tuesday, U.S. retail sales and industrial production. And UK jobs data, if that's up your alley.
Not the UK jobs data. I am curious about U.S. retail sales, just particularly as a setup heading into that Fed meeting. This has been a lot of talk. Inflation is somewhat subdued. The job market weak, but still stable. The question is, are we still spending?
Do people be shopping? I don't know. But let's talk about the Fed decision coming up on Wednesday. Okay. I am very excited, of course, to see what tone Jerome Powell takes when he delivers that 25 basis point cut that Wall Street says he will.
Yeah, I mean, that's the lock. Some people are saying this could be a sell the news event. But the real question is what does he communicate to the market? And then I think to the point, too, that Vincent Reinhart was making when we start talking about economic projections and the dot plot, how much faith can you put in that, knowing that this Fed is going to look a lot different one way or the other in a few months' time?
Absolutely, and that there's people in the room who have been talked about as being the next Fed chair who might be trying to appeal to the president. It's a really interesting conversation, both from an economic perspective and, honestly, from a political jockeying perspective as well.
We're also going to get another read on the economy, but this through the lens of FedEx, of course, one of the biggest shippers in the world. And the Fed decision isn't the only one.
That's true.
BOE.
And then on Friday, the Bank of Japan as well. So it's not just the Fed, but I think all eyes globally will be on it.
And we'll have full coverage of all of those market-moving events right here on Bloomberg Television. We appreciate you joining us this week. Stick around. Balance of Power is next.